You are listening to Keystone's Stock Talk Show, episode 328. Great to chat with you again this week. I kick off the show answering a viewer question on technology-based profitable energy service small cap McCoy Global Inc., symbol MCB on the TSX, which announced a strong Q4 but paused its dividend due to the conflict in Iran. Brennan answers a viewer question on high-flying graphene and hydrogen spec play Hydrograph Clean Power Inc., symbol HG on the CSE or Canadian Stock Exchange. The viewer asked Brennan if Hydrograph could be the next Groupe Dynamite. I will preemptively answer no. No, it is not. Brett updates viewers on Super Microcomputer, SMCI, on the NASDAQ, a provider of application-optimized high-performance server and storage solutions. Finally, Rahil updates VerticalScope Holdings, Inc., symbol FORA or FORA, on the TSX, the formerly high-flying Canadian technology company that builds and operates cloud-based platform for online enthusiast communities. It's now down 72% in the past year. Rahil lets you know if the massive drop is an opportunity or the stock is a falling knife. Okay, let's get to the show. I'm going to welcome my co-hosts, the Killer Bees, Brett and Brennan, and our newest addition, Rahil. Welcome, gentlemen. I think I did the introduction a little more justice at the end there last week. That escaped my screen, that little part at the end. So I just said, welcome, guys, or something like that. I don't know. It's terrible.
Yeah, we got it this week. You brought back the new guy, Keystone's newest addition.
Mm-hmm. Yes, the addition.
Yeah. New analyst, same returns.
Yeah.
True. So what did I do this weekend? Well, we did a polar plunge. So it's for a great cause. Michael Campbell does it every year. You got Aussie Jurek going in there, Gordon Campbell as well. Plunging into the icy waters outside Vancouver. Not really icy, but just bone-chilling cold. It was colder than I thought. We're gonna leave a link to when we send this out and below our YouTube page. If you want to donate to the Special Olympics, it's a great cause. They've raised a great deal of money already. Not because I was going in the water, although people do like to see me freeze. But you can see us going in either lederhosen or hopefully no Speedos, but we went in. People were giving us some strange looks there in English Bay, but it was cold water. Michael just coming off of knee surgery. He's a trooper to go in the water at that point.
No doubt.
But it was good. It was fun. Aussie's in his lederhosen, and it's looking good. We're looking like bozos, but it's for a good cause. So we plunged into the water. It was literally the windiest day of the year.
It looked
like the tankers were going sideways out there. And I felt like it was like we were like George in Seinfeld, where he looks in and says like, the sea is angry, my friends. The sea was angry that day, my friends. But it was really actually, I don't know if the pictures are going to do justice, but the waves hit us and we immediately froze and ran out of the water like small children, right? Although children probably can handle the cold better than us, but it was good.
Yeah, it looked like a lot of fun. You were also wearing a scarf when you when you.
I was a Canadian scarf, man.
Yeah,
I had to add something, right?
Yeah.
I mean, they're in lederhosen. I got to purchase some lederhosen, so I don't have it.
Did you submerge the scarf though when you
partially,
dunked?
But not enough. We were dunking Campbell. No, we weren't dunking him. We were holding him because the knee, like you can't get back up on one side with that surgery. I know my sister had double knee surgery, and it's like there's a while that it's intensive surgery, and a while that you can't do much, and it's getting back up is a bit of an issue. But hopefully he comes out of it with no pain, because she has 2 years later now, she has no pain, able to get up and down stairs. It's awesome. If it's done well and works out, it's great. So hopefully that happens for Michael for sure. And we have a poll question, right? We're also just doing a ton of research right now ahead of going to the Roth conference in California, just to let our clients know and anybody what we do. We look at 550 in that range companies ahead of time. We'll do 20 to 30 interviews there with teams that loosely meet our criteria, and hope to have potentially some buy recommendations coming out of that. I know we've already identified a couple companies we're really interested in talking to there. So hopefully we get some great businesses to come out with some buys for our clients after the Roth conference. It'll be great to actually sit down with those management teams in person. We do the qualitative now. You get into the we do the quantitative. Now you get into the qualitative aspect of it and then judging the management teams in those 30-minute speed dating management team things that we do. So it should be good.
Yeah.
Poll question.
Let's get to the poll.
Yep.
I'll stop talking.
Going on the poll question. So the poll was with the current military action in the Middle East, oil prices have surged with WTI jumping past $90. We're recording this on the Monday, so it was as high as $115 when futures were opening, and now it's down all the way to $85. So very turbulent day.
That is volatility,
which is so high for oil.
Yeah.
That is ridiculous. But if we do see oil stay at these higher levels, will sustained inflation come back? Because that's what I've been seeing headlines concern is, CPI is going to be above 3% now because oil is going up. It pushes up the cost of effectively everything. You need to move things. You need to do your industry. Oil drives the entire world's economy. So when we are seeing from $60 a couple months ago to effectively nearly double at the open of today, that is extreme. But 54% of our viewers said yes, it will result in sustained inflation. We'll see if that would change by now that it's down to 85, and 46% said no. It just shows just how turbulent how turbulent the market is and how hard it is to be to actually predict on a macro level when you have this high volatility. Because if you were saying, I'm scared of inflation, I'm going to sell out of long-term bonds, something like that, because of inflation, and now by the end of the day, not even a day later, that might no longer be a concern.
Yeah. Yeah, I mean, quite the 50-50 split, realistically. Generally speaking, I would say that probably not, sustained inflation. Again, we are seeing, some weaker job numbers out there in the economy. So we'll see what, how that continues. I think that generally it comes down to, how the economies are doing, in each, the US and Canada generally. Again, it's kind of been, some good results over here, some bad results over there. So, it's kind of tough to really gauge. But that's kind of my thoughts is that's really where the rubber is going to meet the road, is just, what are jobs doing, longer term.
Yeah. And I mean, it's how long it lasts, the conflict, and then like how it disrupts some key supply chains, right? If there's rerouting and surcharges that go on things, there can be air cargo, surcharges that go on, charges that go up. You're just not able to get things through, and who is affected from that perspective. That is one of the underrated things of doing these in-person events. We always ask like how during tariff situation or during COVID situation, like how does it affect your supply chain? And you get to talk to like management teams that are literally actually shipping in and out of those regions. Typically you have some team there or a couple teams that you're interviewing that you can ask that, and you get it straight from them rather than getting it just from, I don't know, a news article where, people are either guessing or they're using statistics which is, a way to do too. Look at the stats. But it is nice to talk to the management team where they're saying, yeah, we're shipping this product A from the Middle East, or you're shipping it from China, or you're shipping it from wherever the region that's affected. And this is what's actually happening. This is the cost of a container now versus where it was. This is, this is what you're being told. This is what we're actually, paying. We did that with like a company called Acme, that had shipping scissors out of China, right? Or shipping, any product out of a region, but that was during COVID, and getting the idea of what container costs, the rise in container costs, and whether or not it had started to abate, right? The cost had come down. So you hear that directly from people who are actually doing it, which is very valuable to hear. Mm-hmm. All right, we can move on. Is there anything else we want to get to?
No, I think that the McCoy is a good
Yeah,
run on
McCoy's
kind
a
of.
good start on that too.
Yeah.
Another company that is definitely was directly affected by the conflict in this region. We can
Yeah.
get right to them. So McCoy Global has been a company we've looked at for a number of years. We think it's a good business, looking for an attractive entry point. Do we have that with the drop here? Well, we'll get into that, and we'll tell you why the company had a decline in its share price just over the last couple of days. It's an Edmonton-based technology and equipment provider for the global energy industry, specializes in tubular running services, TRS, and wellbore integrity. Founded back in 1914, the company designs, manufactures high-performance capital equipment such as hydraulic power tongs, casing, running tools, torque monitoring systems, essential for the construction of oil and gas wells. In recent years, McCoy has undergone a digital transformation by launching its smart product line, which integrates automation, machine learning, and cloud-based data collection into historically a manual process. This technology is exemplified by their smart TR system, which aims to enhance safety and efficiency by reducing human error and labor costs on both land and offshore drilling rigs. We can see stock prices around 260. We'll see where it's been over the past year. It's about a $70 million market cap. Now, they had paid a dividend, but that was paused. So I'm putting the yield at nil at present because they're not paying that dividend. This is a basic description of the services: digital solutions, automated data-driven systems for real-time wellbore monitoring. That would be their smart TR, smart CRT, and virtual thread rep. Capital equipment, heavy machinery used for assembling and running pipe into wells, hydraulic power tongs, bucking units, and roughnecks. So aftermarket service would be ongoing revenue from technical support, parts, and consumables. So dies, inserts, gauging, and calibration services. Now, again, the stock's been relatively flat over the past year, but you can see this significant dip there late last week where it announced, it made an announcement, and we can look at the announcement here. Essentially, they posted actually good revenue numbers for Q4. They expanded their smart products, but they paused that dividend amid the conflict in Iran. So let's quickly look at those numbers before we get to the pausing of the dividend. Q4 numbers, revenue was relatively flat, but again, slightly up, driven by good demand for recently commercialized smart products. They had delivered on an $11 million contract that they had announced earlier in the year, and that's fully delivered now. Smart product revenue, again, up significantly, accounted for 55% of the total revenue, an increase of $2 million, around 16%. Net earnings up 44% in the quarter. Adjusted EBITDA was up around 26%. But let's look at the outlook here. Well, in the case of McCoy, there is a distinct near and long-term outlook. So two outlooks, basically. We'll start with the near-term outlook. Subsequent to December 31st, 2025, the abrupt escalation, they said, of the conflict in the Middle East, coupled with effective suspension of shipping through the Strait of Hormuz, is expected to result in delayed shipments and may result in reduced bookings as customers remain preoccupied with safety considerations and operational contingencies at present. So greater than 2/3 of McCoy's December 31st, 2025 backlog is destined for the Middle East. So ongoing shipping suspensions and restrictions and port access may delay delivery schedules and defer associated revenue and cash receipts. While the underlying customer demand remains intact, these timing impacts may pressure ongoing operating cash flow and working capital in the near term. As a result of recent developments in the Middle East, the company expects shipments scheduled for delivery over the next 2 months to be delayed, with associated revenue recognition deferred and cash collection on affected shipments slowing. This is creating a near-term liquidity impact on the business. Visibility remains limited given the fluid nature of the conflict and the evolving shipping and insurance restrictions. At a minimum, the company expects to anticipate delays to orders previously expected from this region in March and April as customers prioritize safety and operational continuity. The company is monitoring the situation closely, and it will reassess its posture as circumstances evolve and adjust its operating plans and logistics as the corridor stabilizes and reopens. Quarterly performance is expected to continue to reflect variability typical of capital equipment markets, where purchasing decisions and shipments schedules often shift between periods. So finally, in response, McCoy paused its quarterly dividend and instituted several cost containment measures to maintain financial flexibility and manage the lack of near-term visibility. These are prudent measures that the company is taking. Now, we'll look also to continue the near-term outlook. In the North American land market, drilling activity continued to trend downward through 2025. So this was without this event that has gone on in the Middle East, with rig counts reaching some of the lowest points observed since 2021. U.S. land activity is anticipated to remain range-bound through 2026. Despite these headwinds, revenue from this region has been supported by McCoy's smart technologies, particularly its smart TR system. At the same time, the industry's investor-driven focus on near-term returns means technology adoption decisions are increasingly conditioned on clear, measurable efficiency gains and visible payback periods. In the long term, again, the long term is more positive here. We'll touch on that in the conclusion, but the near term, there are certainly at least the company is being very cautious in its outlook. So before I look at the valuations here, let's look at the backlog here. So the backlog as at December 31st, 2025 totaled 25.8 million Canadian. That's a decrease of about 7% from 27.7 as at September 30th, or the last quarter, and is a slight increase year over year. So the backlog has not surged as potentially we could have seen in the first couple quarters of this year, and likely not to surge given the near-term issues in the Middle East that is affecting kind of CapEx spending, and people are taking their eye off of new spending and just probably preserving cash flow in the near term. Plus, shipping issues are a big issue for this company. Now, these valuation metrics look very attractive. First, we've got the trailing metrics that just came out for the fiscal 2025 year. It trades at about 7.6 times earnings with a net cash balance sheet. Again, low valuations. These are the analyst forecasts. And now I believe that these will be adjusted lower in the near term, as these didn't factor in some of the activity that's going on and some of the new guidance that's come out from management. Not specific guidance, but in terms of what they're looking at in terms of a weaker first half of this year, that we're surmising from kind of reading what they're talking about in their MD&A here. And I expect these numbers are too optimistic. So likely lower earnings this year than we saw over the course of last year. Now, let's just look at our conclusion here. Although the current market environment may temper the pace of adoption and near-term revenue growth across global geographies may be seen, McCoy remains confident in its technology roadmap. It does still expect over the next 12 months, several TRS contract awards are anticipated, and in aggregate represent a potential opportunity involving more than 100 rigs being allocated to TRS customers. The company, we believe, is well run. It has a good balance sheet, net cash position, and they're preserving that by pausing the dividend in the near term and making some cost savings initiatives. There is near-term uncertainty here, but we continue to monitor for attractive entry points. Again, it's a great example of our philosophy on commodity-related businesses. The dividend in these companies, even when they look secure, are always and should always be considered a bonus. We saw this company a cash-rich, great quarter, but they see the potential for a strain on cash flow going forward. So they've paused that dividend. It may come back in, it may not, but you should always think of it as a bonus in these companies. We want to buy at a significant discount to intrinsic value and stress great balance sheets. It was trading at around 10 times earnings in this segment. That is not a significant discount to intrinsic value. And even now, if it's 7 times in that range, looks like a good valuation. But we do see others. We're researching a company right now that trades at 2 to 3 times. So, there has to be a significant discount to intrinsic value to give us some kind of margin of safety, because these type of businesses are so volatile that it can flip. The valuation situation can flip very quickly. And here we see now, we likely see some weakness over the course of this year. So the valuation metrics come down or go up even with the share price coming down. No current ownership position.
Yeah. And I mean, we've interviewed Jim and Alex from the company multiple times over the years, many conversations. And I think that they're great operators. Obviously this is something that's outside of their control, but as Ryan was saying, it's a very volatile space. And that's why, you can't go out and pay 13 times trailing earnings for
and 13 times doesn't even sound like you're
No.
paying a lot, right?
No.
But you certainly need a margin of safety in these businesses, and you can see that. And counting on a dividend, which some people do. They look at it and say, oh, I'm going to count on that dividend. This is a company that probably we wouldn't have expected to have to be able to cut the dividend.
Yep.
But, it gives you an idea of how volatile this space can be. And management has done nothing wrong. Like, management is operating the business with a great balance sheet. Their payout ratio is low on a relative basis. They mind the store, they're profitable, and they've come out with new products that likely are going to have success. Now, adoption may be slightly delayed because, operators take their eye off the ball, not off the ball, just the eye off growth in a time where you're fearing for near term, you're just watching your supply chain. You're watching whether or not you're going to have enough cash flow coming in to drill the next well. So that's their focus right now, safety and, not growth in the near term. So they're not looking at adopting new technologies. They will have to likely at some point, and it's likely one of the better new technologies out there. But, that's one. And again, these measures management is taking are probably preemptive, and that's probably a really good
Very
thing
prudent.
to be doing. But if you have 2 weaker quarters, we may get what is a quality business at a more significant discount, and then we can be buyers in a more significant way. And we may be looking for that. But it shows you the volatility in these businesses, even when they're well run. Management isn't doing anything wrong, but the markets move against you.
Right. I was looking at the cash balance of the business. The business is sitting at a $3 million worth of cash balance, which is the lowest in the last 8 quarters. So that is something I'll keep an eye on in coming quarters. Where is the cash going? And that might be an indicator why the McCoy, paused their dividends in the short term.
Yeah, for sure. I think they would have expected to win some significant orders over the first half of this year, and now that was probably part of the planning, and they were okay with the cash balance coming down a little, spending and investing in capex. And they also said capex is going to come down this year. So, but now you're at a point where they went to the lowest cash value, which probably was reasonable if the environment stays normal. But the environment isn't normal, and now we're not going to pay this dividend because that's going to be a drain on cash, and we're going to do some cost containment. So, yeah, it flips very quickly in volatile commodity-based businesses. And again, I think it's well run. I like the team. I think we like their products, and they were kind of ahead of schedule with some of the orders that they got last year in that area of the business. So. And those, again, are out in the field now. If they're proven to be far more or just successful as they predict they will be, it provides that use case that you have larger companies then saying, okay, the existing customer can order more. That use case can go to new customers and say, okay, this is working well. Let's bring these products in. But again, now everybody's looking over here, right? They're not looking at that for the near term because you've got relatively unexpected situation going on. It's taking the focus off in the near term, adding new technology.
Yeah, and the other thing is just the time factor of the disruption too. They don't know if it's going to be a month where 60% of their backlog effectively is out, or is it going to be 2-3 years? So when you are doing a dividend, if they were to keep paying their dividend, it does take cash out over time. So if they do that right away, it gives them more flexibility. So then in, let's say the issue, oil is able to move through the Hormuz in half a year, and you start to have some more interest in the region, they're able to then re-implement their dividend earlier, compared to if they just kept on paying it at this point. They're probably going to need a while to rebuild if the issue stays around.
Yeah. No, I mean, that's why we would require that, and we do require these companies, if you're in that segment, to have a good balance sheet, because there's always a rainy day, and that rainy day hit here. And like Rahil said, it's actually the lowest cash balance they've had in probably 3-5 years, right? In that range. And it's unfortunate that it happens to hit at that time. I mean, the other company, again, I'm teasing it. We don't know if we're recommending this business. We haven't. We're interviewing them in like 10 days. So, and then we'll sit down with them in person in probably 2 weeks. But there's $100+ million in that small caps cash balance with no debt. So, and it's trading at lower valuations. So we're always comparing these businesses to, companies within loosely their industry, and is there a better option with more of a margin of safety, cheaper? Again, this may spur some M&A in the field too, because that can happen, right? Like companies can opportunistically take out some businesses that come down. So I think McCoy is a good business, but they've had initial adoption. It still doesn't mean that's going to be successful. So you still have to couch your optimism going forward with, is this going to be adopted and be the de facto tool that's used at the wellhead? So we'll see. But I think they're executing well. It just gives you that. It gives you a kick in the head to say, yes, we need to buy these businesses at a discount, because there is events in volatile commodity businesses that get hit harder than most. So, I mean, it's the reason why we don't pay anything or pay up for, even if it looks like a really good story. All right, let's move on to our next company. I think Brennan's going to do Hydrograph, right? Is that what it is? Apparently the next Groupe Dynamite.
Yes.
No, I kid when I say that.
Yep.
I think what the viewer was actually asking, is it the next strong winner? Is it going to continue to go higher over the long term? Not comparing the two companies, because if we compare the two companies, it's apples to oranges. Right?
Mm-hmm. Yeah, and I'll go through that a little bit here.
Like revenue-based, earnings-based, and from that perspective.
Yeah, exactly. So yeah, this came in from a client, and he said, this past week he said, just wondering if I could get your professional opinion on a stock my coworker bought. I'm wondering if this is another Groupe Dynamite. The company under question is Hydrograph, HG, on the Canadian Securities Exchange. So Hydrograph Clean Power Inc., again, HG on the CSE, currently trading at a price of around $9, market cap of about $3.1 billion. And that's, again, Canadian. They do not pay a dividend, and they engage in the acquisition and development of graphene and hydrogen-related products and services. The company is involved in the research, development, marketing, and commercialization of patented technology to produce pristine graphene, graphene derivatives and services, as well as hydrogen, syngas, and other products for applications in thermoplastics, composites and resin, coatings, lubricants, and concrete cement. Now, the company was founded on a 2014 discovery, which focuses on a detonation process for producing high-quality, low-cost graphene. And the company then received a patent for this process, funded its first graphene plant, and officially went public in late 2021 on the CSE. And since then, the company has been scaling up to commercialize and has added over 60 testing partners for trials of its high-quality graphene. And given the anticipation for commercialization, the stock has gone parabolic in 2025 and 2026, up about 2,900% since mid-2025, and now up 240% year to date. If we look at their financial results, there really isn't too much to say, as the business has produced marginal revenue and no earnings. And as such, we have seen the company go from 187 million shares outstanding in March of 2024, now up to 330 million shares as at December 31st, 2025. It's actually even closer to 340 million after their recent raise. And this is just because the business isn't generating cash flow, and they're needing to fund its ramp up toward commercialization. The balance sheet does remain healthy with a net cash position, but again, this is just because they have been raising money in the market. And to fund the further expansion, the business recently raised another 30 million Canadian dollars by issuing about 6 million shares, which will be used for establishing and staffing the company's new Texas headquarters, advancing the development of its second graphene production facility in Texas, expanding marketing and sales initiatives, supporting ongoing R&D, and funding general working capital needs. In February, Hydrograph announced that it received US EPA and UK REACH and EU REACH regulatory clearances, allowing the company to move from providing research quantities to selling large-scale commercial volumes of their fractal graphene in the US, UK, and European markets. And these clearances specifically target the application in lubricants, resins, composites, polymers, and coatings and energy storage. And the stock price has certainly been reacting positively to this news as I was going over the year-to-date return so far. And in January, the company also announced that it commenced construction of 2 additional graphene reactors, which are expected to each add 10 tons per year of its ultra pure fractal graphene, with commissioning expected in January and February of 2026, after which the units are expected to be relocated to its facility in Austin, Texas, which is under construction now. Looking at the outlook, in 2025, its annual graphene capacity was about 10 tons, but with the new reactors is expecting about 30 tons per year in mid-2026. And by the end of 2026, they're expecting to have annualized capacity upwards of 350 tons when it gets its South Texas pipeline site operational. And management indicates that they can sell graphene with a target price of US $200,000 to $250,000 per ton, which, if we go off of the company's exit targets for 2026, this would be looking at about $87.5 million. That's again US in potential revenue going into fiscal year 2027. But of course, this is just a target right now, and the business does have a lot of work to do to get to this figure. Now, looking at the current valuation, the business is trading at an astronomical trailing price to sales multiple of about 2,900 times. But of course, the market is looking forward. And if we use that US 87.5 million forward revenue figure, which I had on the last slide, the business is still trading at about 26 times forward sales, which is quite pricey. So this means essentially investors are prepaying for 26 years of future success before the first year even happens. And to put that into perspective even further, if the company only hits 50% of its sales target for 2027, that 26 years suddenly turns into a potential 52 years of waiting for the revenue to catch up to the price that you paid. Now, to conclude here, while Hydrograph has successfully cleared major regulatory hurdles and proven its tech, there is a massive delta between its 20,000 quarterly revenue and the $3 billion market cap it is currently carrying. To reach its goal of 350 plus tons, the company remains reliant on capital markets, with shares outstanding ballooning from 187 million to about 340 million in 2 years. And existing shareholders are paying an admission fee for this potential or for the future potential. Now, at its current valuation, the market has already priced in a flawless 2026 expansion into Texas. Any delay in the commissioning of the South Texas facility or a slower than expected conversion of its 60 plus testing customers could trigger a significant correction. And unlike Groupe Dynamite, which we recommended based on attractive multiples and strong existing fundamentals, Hydrograph is still just a story stock. So I wouldn't relate the two businesses. We were saying this at the beginning of the segment as well. history shows that when momentum fades, valuations inevitably revert to fundamental multiples based on revenue, EBITDA, most importantly, cash flow, which right now are currently negligible for Hydrograph. And whether the company will be able to hit its revenue targets and be profitable or generating cash flow is still unknown to us and the market. So, for a disciplined investor, Hydrograph currently represents high risk speculation rather than a value driven investment, which is what our Groupe Dynamite or GRGD recommendation was based on. Until the company shows it can turn kilos of samples into tons of recurring revenue without further massive dilution, the risk to reward ratio remains unattractive to us. And here is the disclosure, but I'd also like to mention that Cielo Waste Solutions, CMC on the TSX Venture, is a textbook example of a green tech darling that collapsed when its engineering reality couldn't keep up with its stock market hype. And in 2021, the stock soared to a valuation of over 1.5 billion, only to crash to basically near zero as of 2026. Now, I'm not saying that this is going to happen to Hydrograph, but I just want to highlight what can happen to story stocks that don't pan out. And for example, Cielo claimed that their proprietary process could turn any landfill waste into high-grade renewable diesel. They signed dozens of MOUs to build 40 plus plants across North America, leading investors to believe they were on the verge of becoming a global energy giant. And management came out with some lofty targets, and which I extrapolated out back in 2021 and highlighted that if they could achieve these highly aggressive numbers, which was the best case scenario, maybe even better than the best case scenario, in my opinion, they were still trading at 12 times forward sales. And like Hydrograph, they went from millions to hundreds of millions of shares outstanding, essentially panhandling from retail investors to keep the lights on while producing zero meaningful revenue. And Cielo proves that planned facilities are not revenue or, more importantly, earnings. They traded on the promise of 40 plants while they couldn't even get one to work. Investors who ignored the $0 in revenue and the massive dilution lost 99% of their capital when the engineering failed to meet the marketing. So again, I'm not saying this is going to happen to Hydrograph by any means, but we have seen dozens of similar story stocks unable to live up to the hype, and an investor willing to pay up for Hydrograph's price to perfection future potential has to be aware of these risks. And now, after bagging on the stock a little bit there, I'll open it up to the guys.
Yeah, and I wouldn't say necessarily you're bagging on the stock. You're just talking about what kind of a profile we're looking for and what type of profile we're looking to avoid. And and this may be a great moonshots story, right? And maybe it does work out, but the profile of the universe that we're looking in, I mean, to give you an idea, when we recommended Groupe Dynamite, it had 800 million in sales, right? And you bought it at 10. We were able to buy it between $10 and $16, and it went to $80. It's trading in that range, and then sales have increased now. 800 to 1.2 billion, right? So 800 million and 1.2 billion, and significant growth there, significant growth in profitability, and it traded at low multiples. It wasn't just making sales. It was, trading at low multiples relative to peers, 10 to 13 times versus, 35 to 40 times what peers were trading at that point. So, I mean, you're just looking at a profile of a business, and, it became a moonshot from that level, right? It did 4 to 5x from those levels, but, you're looking at a profile of a business, and we talk about where do we want to play to find the next 10x stock. Well, you want profitable businesses. We know that profitable businesses are the ones who become the next 10x stock. It's 9 out of 10 of the businesses that become the next 10x stock started off as profitable or have some cash flow before they went higher. You're playing in that small window, that small box of like 1 out of 10 here that can potentially go higher. And again, that's out of stocks that went up 10x. Yeah. I mean, when you're playing in this field of no revenue, promise of future revenue, you're probably talking about 1 in 1,000, really that end up being sustainable long-term winners. So again, that doesn't mean that Hydrograph can't be a great long-term business. It just means we want to hedge our bets in the area that we know, based on the data, based on our anecdotal research over time, where we can find great businesses that grow over the long term. And we just follow the numbers and look for a profile of business like that. This doesn't mean that Hydrograph is a terrible business. It just means that if you want a fighting chance to beat and actually find meaningful, like 10x long-term stocks, it's not the area to look in. Non-profitable, non-revenue based businesses that are promising something into the future that trade at relatively high valuations.
And I would say, like, I think like the easy money has been made, on this stock. Like now, like we've said it before on the podcast, where fundamentals are like gravity. And I think that right now, this is really over, 2026 into 2027. We'll continue to monitor the business. I'll probably, update it on the podcast as well. Eventually as we're tracking their progress. But, this is where the rubber meets the road, in my opinion. Can they do what they're saying? Can they, generate this revenue, and can they be, most importantly, profitable, generating that revenue? Or, are we continuing to see dilution and, current shareholders getting, diluted out for this growth as they're still trying to scale to reach, cash flow or being cash flow positive? We'll see.
Yeah, and that scaling is easier said than done. That's the difficult part, is you'll have these pilot projects, which they have their one is called a Hyperion, is it not? Which is the process they're using and the machine they're using to produce the graphene. And now you have to scale that again and again. But then you have to look at the commercial side. Is you need the buyers, you need to do it cost effective. Is it going to be, like you were saying, 200,000 per ton right now? Does that start to go down once you have them or other competitors? And there are competitors in the space. Come on, does that selling price decline? Is it 100,000 the steady state? Is it gonna, if demand picks up in the broader market, it could potentially go up? But just looking at their presentation, they have primary target and secondary target market, $1 billion by 2028 in composites and batteries, $1.5 billion for the secondary market for concrete and lubricants. Their market cap is over $3 billion, just to give you a size comparison. When you're looking at these absolute sizes, you are paying a lot of money just for the sales. You are paying over 1 times of the entire target market what they have for 2028.
It's a good point.
That is what you can do with these early stage companies, is just look at what they're stating. They'll always have their total addressable market, which are very inflated. Hydrograph does this as well, but most of these smaller companies like to do it. Normally just ignore those. I'm just going to put that out there because they have a $1 trillion market according to those. But once they break it down, they do at least here $2.5 billion. They're still very expensive, even if they could take the entire market, unless they could do it very, very profitably. If it was 100% gross margin, I'm a buyer, but I would not expect anything like that. I would expect it to be quite low at the start, as they are scaling production, as you do have those higher capex costs. And initially as well, utilization could be very low if they can't find initial buyers, because it is a budding technology. Are you actually going to be able to place that? That is so key to this. And it could just wash out the market, and you, like Brennan was saying, you need to keep raising capital again and again, dilute. So even if the idea and the concept works out extremely well, it's the next big thing, it doesn't mean it's a proper investment at the end of the day.
Yeah.
I would only like to add on Brad's comment. At 2,900 times sales, the only thing compounding faster than revenue is investors' imagination.
Yeah,
without a doubt. I know, and from those passionate investors, I guarantee we are going to get comments like, "You don't understand the technology." That's what they're going to say. That is correct. I do not understand the technology. I will say, without a doubt, neither do any of you watching understand the technology. What I can understand is cash flow, and I can make better returns with less risk. And that is the key here, following and investing in great cash flow producing small caps. And the strategy can be repeatable. And that is what is key here. It is a repeatable strategy that we can use on different types of businesses across disparate industries, varying industries, to find the next great story or tech stock, that is, you're kidding yourself if you think you can do that. You will not have enough knowledge in all these different industries, the graphene industry, the whatever industry you're looking at, the SaaS industry, that finding some new and exciting technology. If you can find that, if you're investing in stories versus cash flow, you're likely going to do poorly over the long term. The strategy that we're talking about is repeatable, and that is what is key. And we can understand cash flow regardless of what the business is doing.
It ain't what
And
you don't
can
know.
have those returns that you're looking for. That is, people think, well, once the cash flow is there, you're not going to, the story's already, you've already, the easy money, like Brennan was saying, is already out. Well, Groupe Dynamite traded at below its IPO price when we were able to invest in it. So all the smart money at IPO, we were able to invest in it before, and then it went up 400 or 500%. Hammond Power is a boring business that's up 30,000%. Like, these are cash flow based businesses that you can make the returns you're looking at with these blue sky speculations with less risk. And that is so key. And it's repeatable across different industries. That's what we're trying to get across.
Yeah, like I say this quote all the time. It's from Mark Twain. Even in our recent Vegas presentation, I went over it. But it ain't what you know, or ain't what you don't know, that gets you into trouble. It's what you know for sure that just ain't so. And again, that was like Mark Twain's issue, is he was investing in all of these technologies, and he found out, the hard way, that that's a lousy way to invest long term. Anyways,
Cielo, we were told by so many people, but like, this is a revolutionary technology. Yeah. And we said, look, we don't even understand the technology. Neither do you. And we hate to see what happened, but people lost, you're down 100% in a lot of cases from where most people invested in that stock. And, it's a terrible way to invest. Not specific to this company, because we're going to get people saying, you don't understand.
Bring it on.
It's not specific. It's the profile of the business that we're talking about. And the more you invest in that type of profile, the more money you're going to lose over time. At least give yourself a fighting chance. Follow the cash flow, and we can make more money over the long term. All right. Any other further on this? I'm sure it's going to spur a lot of debate, which is awesome. And we'll love to see the comments. So comment and tell us we're idiots and we don't know the technology. It'd be great. That'll be the first comment. All right, let's move on. Brett's going to take a look at a company that he's looked at in the past. It's Super Microcomputers, SMCI. Right?
Yeah, so it's a company that this is, I think, the fourth time I've looked at it. It's one which we kept getting questions on, and this is one where I want to kind of do where they are now type of story, because it's fallen out of headlines. It was just that big story in 2024. It was really an AI darling, one of the first AI darlings, that like second round after the initial NVIDIA hype. They really came in to the mainstream media or mainstream financial media near the end of the first year so near 2024. At the start of 2024, end of 2023. I think the really big parabolic run was at the start of 2024. So last time we looked at it, it was near the end of 2024. There was a short report. The auditor resigned, which then in turn resulted in the late filing, which could have resulted in delisting, but ultimately didn't, as they were able to find a new auditor, BDO, and file with an extension. So they didn't get delisted, but that was a real concern at the time. And so I just want to follow up on where it was really a couple years ago now, and is there any value to the business now? So Super Microcomputer, symbol SMCI, if you aren't familiar, they trade on the NASDAQ. It's a provider of application-optimized high-performance server and storage solutions. The company develops and builds server solutions and storage systems at scale with its building block solutions. Effectively, right now in the company's current forms, it provides server rack, solutions for the big AI data centers. The company really capitalized on the initial push into liquid cooling for data centers, and it really had a first mover advantage compared to the legacy providers of servers and server racks, Dell, HPE. As AI data centers, they just use a lot more electricity, creates a lot more heat, making a demand for liquid cooling, which traditionally would just be air cooling of some form. So the stock is now trading at $31.13 at $18.7 million market cap, down roughly 16% over the past year. But it was quite a volatile 2025, but it's really settled off the last few months. The last few times we looked at it, you can see here I have up. It was after really it was dropping just every single other month through all of 2024, settled down through 2025, but there was some big news-driven, quarterly-driven numbers that would shoot it up to $60 and come back right back down. So very volatile, even though only down 16% over the past year. So jumping into the last quarter's earnings, the headline numbers for it, revenue jumped a whopping 123% year over year. That's 153% quarter over quarter to $12.7 billion. This was largely due to actually quite inflated numbers, as there was a delay in Q1, which added $1.5 billion due to delayment in shipments, which they attributed to customer readiness. Management attributes 90% of the revenue to AI GPU platforms, so your AI compute. Just to give you an idea, it is very dependent on the AI build out of the data centers. So if that slows down, that's the macro impact, it will slow down too. Very in tune with that. Non-GAAP gross margin came in at 6.4%. That's down 310 basis points, 3.1% quarter over quarter, 550 basis points year over year. So the margin story has been my concern since it initially went up, and why the valuation started to just skyrocket in 2024. As over time, which we are seeing now, is there's commoditization of the solutions. They were that first mover, especially in the liquid cooling. So even though with the record revenue we are seeing now, and really a blowout quarter if you were just to look in isolation of revenue, obviously there's the caveat of the shifting from Q1 to Q2 with that delay. It has to actually compete on price now. Component cost increases, and they had to expedite shipping to customers, as well as just cost competing to retain market share in a growing market. So when you are seeing these margins drop, it is a big concern, because it's not just sales that matters. What matters more is the earnings and cash flows. So non-GAAP EPS did come in at 69 cents compared to 59% in the prior year and 35 cents in the prior quarter. So bit uptick, but not that 100+% like you are seeing with revenue. The company is also now firmly in a net debt position of $787 million, with a debt primarily composed of $4.7 billion in convertible notes, which at the current price are well out of the money of their conversion prices. So likely won't be converting to equity at this time unless we do see a surge in stock price, which I wouldn't put out of the question, but it might be short-lived given just its recent, you can just look at 2025, the recent volatility. But this is overall a weakening of balance sheet over the past year or so. Prior to net cash positions, there is quite a bit of working capital flux, but the absolute leverage in isolation is 0.5 times adjusted EBITDA is fine. That's much lower than Dell or HP. The company does, however, have a significant receivable balance of $11 billion, well above the norm for itself, which is stressing cash flows. And I will note as well, 72% of that receivable is related to one key customer. And I think it's about 63% of the revenue is that key customer, which does introduce risk. This hasn't been confirmed by management or in their filings, but it's widely to be believed that it's xAI, Elon Musk's AI company, which has been actually absorbed under SpaceX. As well, management did confirm in their last conference call that Supermicro is now using receivable financing, receivable factoring in 2026. They weren't in this quarter, but in the current quarter, they will be. So, and effectively receivable financing is selling your receivable to receive a medium payment. You take let's say a percent discount. So you get 99% of the receivable, which does indicate at least a degree of cash flow strain, as they are needing to take a haircut on their receivable. So guidance for Q3 is $12.3 billion revenue, GAAP EPS of at least 52 cents, and non-GAAP EPS of 60 cents. They like to do this at least, so I would expect them to. They have followed through relatively good with that. There has been misses before, though, but they are saying it is conservative, but people, due to all the issues, don't really trust management either. So I will just mention that. But would be a decline or flat quarter over quarter, but would still be a large year over year increase across the board. As well, they are saying at least $40 billion in revenue for fiscal year 26. We're in fiscal Q2 right now, so it's offset by 6 months. Now zooming quite a bit out just to show the long-term trends on margins, gross and net margin. During the initial AI boom, Supermicro saw a big jump in gross margins. You can see just visually, big increase in it as they were able to capitalize on their first mover advantage. They were the ones doing the liquid cooling. But over the past year, gross margin has just collapsed below even the pre-AI era. The net margin is lower than the AI boom period, but roughly equal to that pre-AI era, between that 2 to 4% historic net margin. The revenue has gone up exponentially, allowing for operational scale, but competing for market share has offset the benefit, resulting in that 2 to 4% historic net margin range once again. So even when you are getting better sales, if you are seeing a decline in margin, it isn't bringing any uplift to the bottom line. It is not really a growing business just because the sales are growing. Management does want to bring margin up with DCBBS, Data Center Building Block Solutions, which is effectively a full stack data center offering compared to his historic rack focus that the company they just introduced this last year. DCBBS boasts an approximate 20% gross margin, so that's well above, about triple what they did in the last quarter. So for as far as company-wide goes, but as of Q2, DCBBS only accounted for 4% of profit. Management does expect this to be double digits by the end of 2026, but you really need to see them execute on that because these margins just aren't great at this time. You need to actually see an uplift to really see true value being built with a company like this. Looking at valuations, they have come down on a sales basis as we have looked, but similar on an earnings basis, which is what matters much more. The stock is trading at a trailing adjusted P of 17.8 times, 22.9 times gap, and a forward price to sales of 0.47 times, which is historically lower. But as I was stating, revenue has increased, but the margins have decreased. As well, past the financials, another factor that will just pressure share price until you see a resolution or just time permits. There has been a DOJ and SEC investigation, which followed that short report last year, about a year and a half ago, which should, and it is causing overhang on the share price. If nothing comes of it, there will still likely be concerns. Still, people do not trust the stock. People who bought it when it was $120 aren't exactly happy with it, that shareholder base. And as well, management, just for a note, they did confirm that there was subpoenas from DOJ in early 2025. And as well, BDO, the current auditor, had an adverse opinion during that same period. So really big concerns, highlighting internal control issues, and management has really just lost significant favor with the market, which can put a cap on valuations if you just don't trust management. Concluding, SMCI has been able to scale volume and revenue, but this has been at the cost of margin, meaning earnings. What really matters has not been growing at this time. The balance sheet is weaker with now a net debt position, as well as that concentration of receivables, as well as just revenue customer concentration, and the fact that the company actually needs to factor receivables. If they aren't able to receive those payments, if XAI, if that is them, doesn't want to pay them for whatever reason or can't, then that can cause a massive concern. Whether or not that happens, I wouldn't say it's likely, but it is a concern when you do see, especially for these large companies, 50+% concentration, even 10% is when they have to disclose in their filings. DCBBS, if it can be executed on with those higher 20% margins, can be the savior for the stock. But given it's only 4% of the profit at this time, it needs to grow dramatically to really move the needle. Even at 10%, that's only really a nice little cherry on top more than anything. It's not going to make or break the company. You would need to see it actually become a good portion of the business, if not a dominant portion, to actually drive a better valuation. The valuation, while cheaper than it has been previously, is not cheap if the company cannot overcome this margin problem, as well as the DOJ and SEC overhang and any other lawsuits, if anything comes as part of that. For now, we will continue to monitor the stock to see if it has meaningful financial improvements, really focusing on those margins. And that's why I've been stressing it so much. And just for disclosure, we don't have a position or relationship with the company.
Yeah, it's interesting. I mean, I think it comes down to the margin depression, and I think you were the contraction over time. You're talking about because their technology isn't revolutionary. It is, I mean, it's it is a business that we thought the margin would come down. They were a first mover. They got to take advantage of pricing at that point, and now it's come down. And I think that's why you're seeing. I mean, that's why I wouldn't be an investor, even though if you see EPS growth going forward near term. Here, I wouldn't be an investor given the fact that margins are declining, and they probably just keep declining.
Exactly, and that's really the problem with these commoditized businesses as well. That was similar concerns I had with Celestica as well. That one's been doing much better than SMCI. Similar concerns there. They have been able to differentiate themselves a bit better in that market, but these what historically have been commoditized technologies or integrators do end up falling in margins because once there is the supply meets demand, they can't get their premium anymore, and you can't pay up for that valuation wise.
Yeah, makes sense. All right, I think we can move on. We're gonna have Rahil present right at the end, and he's going to talk about what is FORA is the symbol, but VerticalScope is the business.
Awesome. Let's start with the basics. VerticalScope is a Canadian technology company that owns over 1,200 online forums and communities. These are the websites where people talk about things they love, such as cars, motorcycles, woodworking, mountain biking, guitars, dogs, etc. You name it. Right now, they have about 86 million people visiting their sites every month and 70 million members. The platform has over 2.3 billion posts. That is a massive library of real human conversations. The stock trades on the TSX under the ticker FORA. The share price is around $3.12, and the whole company is valued at about $75 million. There is no dividend. This is a growth story. Moving on to the history and the business model, VerticalScope went public in June 2021. They raised $125 million at $22 per share. The stock then shot up to about $34 just a couple of months later. That was the COVID era of when the tech stocks were flying. Then things got ugly. The stock fell all the way down to around $2.39 at its recent low, mostly because of fears around AI destroying their business. So, how do they actually make money? Two main ways. First, digital advertising. Brands pay to put ads in front of their audiences. Second is e commerce. They earn commissions when users buy products through their communities. How do they build all of these communities? The answer is acquisitions. They have made over 230 acquisitions all over the years, basically buying existing online forums and moving them onto their own technology platform called Fora. That platform improves the user experience and helps them make more money from each community. Let's look at their operational and financial trends. This slide tells the story of 2024 versus 2025, and it's a narrative of 2 years. In 2024, monthly active users were running between 110 and 120 million per year. Then in early 2025, Google changed its search algorithm. That one update knocked VerticalScope's traffic down hard. Users dropped all the way from to around 83 million by mid 2025. The good news is that Q4 showed a small recovery back to 86 million. Revenue per user, meaning how much money they make from each visitor, actually improved through 2025, going from 4 cents to 6 cents per user. That shows the business is getting better at monetizing the audience it does have. Well, on the revenue and profit side, quarterly revenue peaked near $20 million in Q4 fiscal 2024, then dropped significantly in 2025, and EBITDA dropped from peak of $10 million to $7 million last quarter, year over year. So, what is Fora doing to fix this problem? This slide is really the heart of the investment thesis right now. The company is not just sitting around waiting for Google to send them traffic again, they are actively building new ways to grow. The biggest new initiative is called Audience Engine. Think of it this way: instead of waiting for users to find them through Google, they are now going on to other platforms to find users and bring them in. It is completely different playbook. They went from zero to $1.4 million in annualized EBITDA from this product just in a few weeks in January. They are also blocking AI companies from stealing their content for free. They put in technology called Toolbit in September 2025 that blocks unauthorized scraping bots. Between then and January, they blocked 415 million attempts. They are now in active negotiations with major AI companies to get paid for that content access. Other AI players like Reddit are also suing AI companies over this issue. VerticalScope is watching closely and protecting its rights. If they land even one data licensing deal, it could be a big revenue boost that nobody is currently pressing in. So let's look at if this stock is cheap. Going through the valuation, basically what you are paying for this company right now. The company has $28 million in net debt. That debt compared to their annual EBITDA is around 1.3 times. That is a very manageable level. The current ratio is 2.6 and the balance sheet is decent. Now the valuation multiples EV to EBITDA of 3.8 times, meaning you are paying less than $4 for every dollar of EBITDA. EV to revenue of 1.4 means the entire company is valued at just over 1 year of sales. To put it simply, if this business stabilizes and starts growing again, the stock looks very inexpensive at these levels. The market is pricing in a lot of continued pain. If the new initiatives work, the upside could be significant. Moving on to why would you buy this stock and why might you be wrong? Let's be balanced here and look at both sides. The bull case starts with timing. The Google traffic hit happened in early 2025. By the second half of 2026, they will be comparing against those already bad numbers, so the year over year results will automatically look better even if nothing else changes. That is what investors call lapping the comps. Beyond that, Audience Engine is already generating real profit and growing fast. Direct advertising bookings for 2026 are already up double digits. Brands are actively seeking out authentic niche audiences, and that is exactly what Vertical Scope has. Their costs are flat, so any new revenue flows almost entirely go down to the bottom line. The data licensing wildcard is also huge. They blocked 415 million AI scrap attempts. If they close even one commercial deal with a major AI company to license the content, it could be a major surprise to the upside. Nobody's paying for that possibility right now. Now, the bear case and the things we should watch out for. Google could keep making algorithm changes that hurt forum style content permanently. Audience engines sounds exciting, but it is very early right now. The cost of acquiring user could rise quickly and eat into margins. Data licensing negotiations could drag on for years or fall apart completely, and the first half of 2026 will probably still look weak or on paper, which could keep the stock under pressure. So the bottom line is this is a high risk, potentially high reward situation. It is a small, illiquid Canadian stock going through a real transition. The business generates genuine cash, the balance sheet is decent, and the new initiatives are showing early promise. But you need to be patient here and you need to be comfortable with the uncertainty.
Yeah, I think it's going to be really interesting too. Like, I mean, you mentioned it, but just with all these AI companies scraping these websites, like we're starting to see, some litigation and some jurisdiction wins, from my understanding. But yeah, it's really going to be interesting to see, how that develops.
Mhm.
Is that going to, kind of strangle the, chat or like AI, for example, to some degree where they can't scrape everything that they want, and they have to pay up for
Mhm. I
Yeah, I mean, there
think.
should be ownership of data, right?
it.
And and then ownership of if you've created it or you've aggregated it and potentially created it for sure.
Hmm.
There should be some kind of ownership, and it is a bit of a wild west at the
It
start,
is.
most, so that you could see some
Yeah.
some cases go in favor of like who owns the data, and then you have a changing landscape. So it's interesting.
Mhm.
Yeah.
Yeah.
Yeah, yeah,
Yeah,
we'll keep an eye on the number of visitors on the platform and the average
Hmm.
revenue per user. I think that's an important metric to keep an eye on.
yeah, and
Yeah.
you mentioned comparing them to Reddit. Reddit had a similar thing. They used to have an open API, where then once LLM started to take off, they switched it to a closed API. So then they were effectively locking out any free access or easy access to their data set. And so then you had to revert to scraping, which like you have here, you can at least mitigate to a degree, make it harder for these AI companies too. And then now they're selling it. And that's really been a major catalyst for Reddit, which is larger, but I could see many of these AI companies wanting to have still human generated content that isn't just AI regurgitation of itself at this point, to build into their data set. And that does have real value. But then my question is, why haven't they been able to get a license yet? Because you, like I said, with Reddit, that was a couple years ago now. That's decades ago as far as AI goes. So why hasn't there been some licensing deal at this time?
Yeah, do the models, like the people behind the models, think they already have enough data, like, and they don't need more? I'm not, I'm not an expert in that area, but I mean, potentially that's, where you've gotten to. But you'd think they could start selling it. But
Yeah, like one question that I would have as well, just like on Fora here, is just, are we seeing kind of the discount, or like the valuation discount, is a part of like maybe a little bit of a lack of like, you know, like high quality intellectual property, for example. Like for example, gambling.com, a company we've looked at many times. It's just, great financials, cash rich, but it's just always been so cheap. They're basically like a Trivago for, gambling sites. Like I wonder if maybe something like that is happening to a business like this. Maybe not. I'm just, spitballing essentially. But, I've had many clients, look at, gambling.com, and it's like, wow, like this looks cheap. But I really feel that is the reason that business is cheap. The fundamentals look decent, but just kind of the lack of kind of like IP, where again, they're basically just sending people to these other gambling sites. It's they're making money, but yeah, just not like a groundbreaking technology by any means, I guess. And they have just tons of websites essentially, which is kind of similar, I believe.
I think the concern is real. I think over the weekend I had to research something about my 14-month-old not taking proper naps in the afternoon
Yep.
since he has been to the daycare, and I did not go to their parenting community. I literally searched on ChatGPT what the real issue is, and found the problem solution to the problem.
yeah,
So I think the concern is real, and people using less and less of their communities is a major concern for them.
Yeah.
yeah, I mean, that's a point. You used to go to whatever parenting.com to find like this issue, and then search through a forum and find, okay, this person. Now you're asking Gemini, you're asking Chat GPT, you're asking
Yeah.
one of these models, just and getting answers that have been scraped from them. Now, can they pivot the model and use, because was this information originally taken from one of these AI models, grabbing the data from there, so from one of their sites? So can they sell that, or can they claim that you stole it and retroactively license it or something like that? Like, can that be done? Because I mean, if it was just scraped off and it is data that they own, then there's probably a case there. But they take a shift of model from just the advertising model.
Yeah.
But you are bypassing where you don't even see the ad. You don't even go to that site right there. So
Yeah.
and it's anecdotal, but it is happening more and more often than just searching the web for that parenting website or that dog website that you used to go to get the information you need. Yeah, it is interesting to see how that evolves.
Yeah.
All right, I think that's going to end off our show for this week. Again, if you want to support that Polar Plunge, we'll put the link below, and you can donate to the Special Olympics there. If you are watching this on YouTube right now, smash that subscribe button. If you're listening to this wherever you consume your podcast, rate and review us. Keep your questions coming in to our Your Stock, Our Take segment. We'll endeavor to answer those on a weekly basis. And as always, I wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.
Thank you.